Gold markets experienced the most dramatic single-day volatility in recorded financial history, with market value surging $5.5 trillion before collapsing $3.2 trillion within hours and recovering $2.3 trillion. This unprecedented price action transcends normal market behavior and represents systematic breakdown of traditional gold market structure. The mathematics of such extreme movements suggest forced liquidation and panic buying rather than organic price discovery through normal supply-demand relationships. Understanding the magnitude requires contextualizing $5.5 trillion against global gold market capitalization. Total above-ground gold stocks approximate $15 trillion in value at recent prices. A single-day value fluctuation of $5.5 trillion represents over one-third of total global gold market capitalization. Such movements exceed anything witnessed during previous monetary crises, including the 1971 Nixon shock or 2008 financial collapse. The intraday volatility pattern reveals systematic market structure breakdown rather than normal trading activity. Forced liquidation creates downward price spirals when leveraged positions face margin calls, requiring immediate selling regardless of fundamental considerations. Panic buying generates upward price explosions when institutional investors simultaneously seek gold exposure during crisis conditions while available supply remains constrained by physical market limitations. Traditional gold market liquidity evaporated during extreme volatility periods as normal market makers withdrew from trading activity, unable to manage risks during unprecedented price swings. Electronic trading systems designed for normal volatility parameters malfunctioned when price movements exceeded programmed limits. Human traders could not process information or execute decisions fast enough to maintain orderly markets during extreme conditions. The forced liquidation component reflects massive unwinding of leveraged gold positions by hedge funds, commodity trading advisors, and institutional investors facing margin calls as volatility triggered risk management protocols. When gold prices declined rapidly, leveraged long positions required additional capital or forced selling to meet margin requirements. Simultaneous selling by multiple leveraged participants overwhelmed available buying interest and accelerated price declines. Algorithmic trading systems amplified volatility through momentum-following strategies that generate additional selling when prices decline rapidly or additional buying when prices surge dramatically. High-frequency trading programs designed for normal market conditions often malfunction during extreme volatility by executing trades based on outdated algorithms unsuitable for crisis conditions. These systematic trading strategies created feedback loops that amplified underlying price movements. Derivatives markets experienced particularly severe disruption as options market makers struggled to hedge positions during extreme underlying price movements, while futures markets faced delivery concerns when paper trading disconnected from physical availability. Exchange-traded funds tracking gold prices encountered redemption pressures requiring physical gold purchases exactly when metal became most difficult to source at reasonable prices. The panic buying phase began when institutional investors recognized that traditional portfolio hedging strategies were failing during systematic market stress. Government bonds typically provide portfolio protection during equity market declines, but offered no safety when currency and fiscal concerns drive gold demand. Corporate bonds face credit risks during economic uncertainty, while bank deposits encounter institutional solvency questions. Central banks contributed to panic buying through emergency gold purchases designed to stabilize their balance sheets during currency market turmoil. Multiple central banks simultaneously increased gold reserves while reducing exposure to government bonds and foreign currency holdings. This coordinated central bank buying created institutional demand that private markets could not absorb without dramatic price increases. Sovereign wealth funds and pension systems implemented emergency portfolio rebalancing toward gold when traditional asset classes experienced correlated declines that destroyed normal diversification benefits. When stocks, bonds, and real estate decline simultaneously during systematic crisis, gold provides the only major asset class offering potential portfolio protection. These institutional shifts created demand measured in hundreds of billions of dollars. The major bank response through rapidly escalating price targets reveals fundamental changes in market dynamics, where banks no longer control gold price direction through coordinated short selling or derivative manipulation. Goldman Sachs, Deutsche Bank, and JP Morgan raising targets from $5,400 to $8,500 within days suggests recognition that normal bank influence over precious metals pricing has ended. Historically, major investment banks maintained substantial short positions in gold derivatives that enabled them to suppress prices through coordinated selling programs and paper market manipulation. The rapid capitulation evident in dramatically higher price targets suggests these short positions have been overwhelmed by buying pressure that banks cannot control through traditional intervention mechanisms. Bank trading desks that previously profited from gold price suppression now face massive losses on derivative positions while confronting client demand for physical gold exposure that cannot be satisfied through paper instruments. The shift from market manipulation toward following market direction represents acknowledgement that fundamental supply-demand forces now determine gold prices rather than bank trading strategies. The speed of target price increases from major banks indicates recognition that gold markets have entered parabolic phases where normal valuation metrics become irrelevant. $8,500 gold represents over triple current price levels, but reflects mathematical modeling of potential outcomes when institutional portfolio allocation toward gold accelerates during monetary system stress. Central bank behavior shows coordinated movement toward gold accumulation, while reducing government bond holdings that have served as primary reserves for decades. Official sector gold purchases reached record levels even before current crisis, while central banks reduced dollar-denominated asset exposure. Current crisis conditions have accelerated these trends toward unprecedented levels. The People's Bank of China has increased gold reserves substantially while reducing U.S. Treasury holdings through systematic portfolio rebalancing that prioritizes strategic autonomy over investment returns. Russian central bank gold accumulation continues, despite sanctions pressures, while European central banks reconsider reserve currency diversification away from dollar-dominated assets. Developing nation central banks show particularly aggressive gold accumulation as they recognize that traditional reserve assets, including government bonds and foreign currency deposits, can be frozen or confiscated through sanctions regimes. Gold provides neutral reserve assets that maintain value independently from political relationships or sanctions programs implemented by major powers. Private institutional investors, including insurance companies, pension funds, and endowments, are implementing permanent portfolio allocation increases toward gold rather than temporary tactical positions. Academic research on portfolio optimization increasingly recommends gold allocations between 5 and 15% of total assets, while institutional investment policies incorporate strategic precious metals positions. The bond market confidence erosion reflects recognition that government debt levels throughout developed economies have reached mathematically unsustainable ratios relative to economic output. Total government debt service costs now exceed economic growth in multiple major economies, while demographic changes increase spending obligations that cannot be reduced through normal political processes. Traditional safe haven government bonds offer negative real yields while facing potential default risks if debt service becomes impossible through normal taxation and economic growth. Corporate bonds carry credit risks that increase during economic uncertainty while facing refinancing challenges when interest rates increase substantially. These conditions drive systematic movement toward gold as the only major asset class offering genuine safety during monetary stress. The portfolio shifting process creates self-reinforcing demand cycles as institutional gold purchases reduce available supply, while encouraging additional investment by demonstrating gold's portfolio protection effectiveness. As more institutions increase gold allocations, it validates gold investment strategies while creating additional demand pressure from institutions seeking to follow successful positioning examples. Money managers face career risks from being underweight gold during periods when gold provides superior portfolio protection compared to traditional assets. Professional investment management increasingly recognizes gold as essential portfolio component rather than speculative commodity position. This professional recognition creates systematic demand that operates independently from retail investor sentiment or speculative trading activity. Leverage destruction affects multiple market participants, including hedge funds, commodity trading advisors, and individual investors who utilized borrowed money to purchase gold positions. When volatility increases dramatically, margin requirements increase while forced liquidation levels move closer to current prices. Leveraged investors face impossible choices between providing additional capital or accepting forced position closure at potentially devastating losses. The mathematics of leverage work against investors during extreme volatility because small price movements create large portfolio impacts, while margin calls require immediate response, regardless of longer-term investment merit. Investors utilizing 2-to-1 leverage can face complete position loss from 50% adverse price movements, while higher leverage ratios create even greater vulnerability to volatility-driven losses. Professional trading firms that previously profited from gold volatility through sophisticated arbitrage and market-making strategies now face conditions that exceed their risk management capabilities. Statistical arbitrage systems designed for normal market conditions cannot function when correlations break down and historical relationships no longer predict future behavior. High-frequency trading firms that provide electronic market liquidity typically withdraw during extreme volatility periods when their algorithms cannot manage risks effectively. This liquidity withdrawal amplifies volatility while creating market conditions where large transactions generate disproportionate price impacts due to reduced market depth and participation. Physical gold investors maintain advantages during extreme volatility because they avoid margin calls and forced liquidation while benefiting from long-term portfolio protection that gold provides during monetary system stress. Physical ownership eliminates counterparty risks while providing direct exposure to gold's monetary properties without dependence on financial system stability. Storage and insurance considerations for physical gold become more complex during crisis periods, but provide essential protection against systematic risks that affect paper assets. Professional vault operators experience increased demand while implementing enhanced security measures appropriate for higher gold valuations and increased client concerns about institutional stability. The new financial regime emergence reflects fundamental changes in global monetary relationships where traditional safe haven assets have lost reliability while gold reclaims historical monetary functions. This represents reversal of financial system evolution that occurred during the 20th century, when government bonds replaced gold as primary reserve assets. Monetary policy effectiveness faces limitations when traditional tools, including interest rate changes, cannot address underlying fiscal problems or restore confidence in government debt sustainability. When central banks cannot provide credible solutions to systematic monetary problems, markets seek alternatives that provide genuine value storage and purchasing power protection. Currency competition intensifies as major economies implement policies that undermine their currency credibility while encouraging movement toward neutral monetary assets, including gold, that maintain value independently from government policy decisions. This creates permanent structural demand for gold rather than temporary crisis-driven investment flows. The technology implications include breakdown of electronic trading systems and algorithmic strategies designed for normal market conditions, while physical gold markets operate independently from technological infrastructure. When electronic financial systems experience stress or failure, gold provides monetary backup that functions without electricity or communication networks. Geopolitical tensions contribute to gold demand through multiple channels, including safe haven buying during international conflicts and strategic reserve accumulation by countries seeking independence from Western financial systems. Military conflicts create resource scarcity and economic uncertainty that historically benefit gold prices, while international sanctions encourage neutral asset accumulation. International trade relationships face disruption when traditional payment systems become unreliable due to sanctions risks or banking system instability. Gold provides neutral settlement mechanisms that function independently from political relationships while maintaining universal acceptance across different economic systems and cultural boundaries. The insurance function of gold operates differently during extreme volatility because it provides portfolio protection against systematic risks rather than normal market fluctuations. Traditional portfolio insurance through options or other derivatives may prove inadequate when underlying assumptions about market relationships break down during crisis conditions. Professional risk management frameworks increasingly recognize gold as an essential component of crisis preparedness rather than optional portfolio diversification. When multiple asset classes experience correlated declines during systematic stress, gold provides the primary alternative that maintains value while offering liquidity for portfolio adjustments. Market structure evolution toward physical preference reflects fundamental changes in investor psychology and institutional risk assessment that could persist even after immediate crisis conditions resolve. The recognition of counterparty risks and manipulation potential in paper markets encourages permanent shifts toward physical ownership that alter long-term demand patterns. Emergency policy responses, including trading suspensions, position limits, or forced cash settlement, could affect paper gold markets while potentially increasing demand for physical gold that remains outside regulatory control. Government intervention in gold markets risks destroying confidence in official pricing mechanisms while encouraging black market trading that operates independently from regulated exchanges. International cooperation becomes more difficult when gold market disruption affects multiple countries simultaneously while national interests diverge regarding appropriate policy responses. Some countries may benefit from higher gold prices through mining production, while others face increased costs for gold imports or central bank reserve management. The wealth transfer implications affect different population groups differently, as holders of physical gold and gold mining assets benefit from price increases, while holders of debt instruments and cash deposits face reduced purchasing power. This creates social and political tensions that could affect government policy responses and institutional stability. Historical precedent suggests that extreme gold market volatility often coincides with major monetary system transitions, where existing arrangements prove unsustainable and require fundamental restructuring. Previous episodes, including the 1930s gold standard collapse and 1970s inflation crisis, both involved dramatic gold price increases during broader systematic changes. However, current conditions differ from historical precedents due to much larger financial markets, greater institutional gold ownership, and technological capabilities that enable rapid global capital flows. These differences suggest that current developments could exceed historical precedents in both magnitude and speed while creating outcomes that challenge existing analytical frameworks. The mathematical inevitability underlying current conditions reflects decades of debt accumulation and monetary expansion that create systematic pressures requiring resolution through either debt defaults or currency debasement. Gold provides protection against both scenarios while offering positive return potential if monetary authorities choose currency debasement over systematic collapse. Understanding these dynamics provides context for recognizing that extreme gold market volatility represents early stages of broader monetary system transition rather than isolated commodity market disruption. The convergence of fiscal unsustainability Currency competition and geopolitical tensions creates conditions where gold's traditional monetary functions become increasingly relevant for both institutional and individual investors seeking portfolio protection during uncertain transitional periods.